You're about to spend $500,000 on a house, and over the next 30 years, you will hand over nearly 1 million additional dollars. Dollars you will never see again. Dollars that will never grow. Dollars that will never compound. Dollars that are, for all practical purposes, dead. And at the end of those 30 years, everyone around you, your parents, your coworkers, the entire financial media will congratulate you on the smartest decision you ever made. I know that sounds dramatic, so let me earn it. This video comes down to a single idea, and I'm going to give it to you right now so you can watch for it in every number I show you. The idea is dead money. Dead money is every dollar you spend on your house that never comes back to you and never grows. It doesn't build equity. It doesn't compound. It doesn't appreciate. It just leaves your bank account and vanishes. And the question this whole video is built around is this: how much of what you spend on a house is actually alive, meaning it's building your wealth, and how much of it is dead? The answer, when you run the numbers, changes the entire conversation about renting versus buying. By the end of this video, you'll be able to do this math yourself on the back of an envelope for any house at any price. That's the goal, not to tell you what to do, to show you what the numbers say and then let you decide. But first, let me be honest about something, because that's how this channel works. This is not a video about homeownership being stupid. It's not. Owning a home gives you stability. It gives you roots. It gives you a fixed mortgage payment that doesn't go up when your landlord feels like raising the rent. It gives you a place where no one can tell you to leave. And for millions of people, it's the only way they'll ever accumulate any wealth at all, not because it's the best wealth building tool, but because it's the only one they'll actually use. A house is a forced savings account. You can't skip a mortgage payment the way you can skip a contribution to your brokerage account, and that behavioral advantage is real. I will never dismiss it. So if you own a home and you love it and it gives your family security, this video is not an attack on you. You made a fine decision. What this video is about is the math that almost nobody shows you, the math behind the claim that renting is throwing money away. Because when you actually run the numbers on what homeownership costs versus what strategic renting and investing costs, the result isn't what most people expect. And I think you deserve to see it before you sign a 30-year contract. So let's build this from the ground up. Think of your house as a bucket. Every month, you pour money into that bucket. Some of that money stays in the bucket. It builds equity. It becomes yours. That's alive money. But the bucket has holes in the bottom. And money leaks out of those holes every single month, silently, permanently. Interest payments whole. Property taxes whole. Homeowner's insurance whole. Maintenance and repairs whole. That money hits the ground and it's gone. Dead money. The critical question is, how big are the holes? Let me show you. Here's our homeowner. She buys a $500,000 house in 2026. She puts 20% down. That's $100,000 of her own savings. She takes a mortgage for the remaining $400,000 at today's going rate. Right now, the average 30-year fixed mortgage is running about 6.5%. But let's round up to 7, because that's what a lot of real borrowers are actually paying once you factor in less than perfect credit and closing costs rolled into the rate. At 7% on $400,000, her monthly principal and interest payment is $2,661. Now here's the first piece of dead money math, and it's the one that surprises people the most. In her very first month of that mortgage, she sends the bank $2,661. How much of that goes to paying down her loan? The alive money, $328. The other $2,333. Pure interest. Dead money. Gone. Sit with that for a second. Out of every dollar she sends the bank in month 1, 87 cents is dead, 13 cents is alive, and that ratio barely moves for years. After 12 full months of payments, a full year, over $31,000 sent to the bank, she's paid down her $400,000 loan by roughly $4,000. She's built $4,000 of equity from over $31,000 in payments. The other $27,000, interest, dead. But the mortgage payment is just one hole in the bucket. Add property taxes. The national average effective rate is about 1.5% of the home's value. On a $500,000 house, that's $7,500 a year, or $625 a month. Dead money, every penny of it. You never get property taxes back. Add homeowner's insurance. A reasonable estimate for a $500,000 home is about $150 a month, dead money. Add maintenance and repairs. The standard rule of thumb in the industry is 1% of the home's value per year. That's $5,000 a year, $416 a month. Some years you'll spend less. Some years the roof needs replacing and you'll spend a lot more. But over 30 years, 1% per year is a well-established average, dead money. Now stack it all up. Her total monthly cost to own this house: $2,661 for the mortgage, $625 for property taxes, $150 for insurance, $416 for maintenance. Total $3,852 a month. And in that first year, how much of that $3,852 is dead money? Add it up. $2,333 in interest, $625 in property taxes, $150 in insurance, $416 in maintenance. That's $3,524 a month, dead. $328 a month is alive, building equity. Run the dead money ratio on that. 91.5% of every dollar she spends on her house in year one is dead. She keeps 9 cents on the dollar. Now here's where it gets really interesting. Let's meet the renter. She finds a comparable home in the same area, and she rents it for $2,500 a month. Is that rent dead money? Yes, every cent. Rent builds zero equity. The throwing money away crowd is right about that. But here's what they never do. They never compare the total dead money. They just look at the renter's column and say 100% dead, and look at the homeowner's column and say she's building equity, but they never add up all the holes in the homeowner's bucket. Same budget. Both women spend $3,852 a month on housing, one by owning, one by renting. The renter sends $2,500 to her landlord. That leaves $1,352 a month that the homeowner is spending, but the renter is not. Now, here's the move. The renter takes that $100,000 she didn't lock up in a down payment and puts it into a low-cost S&P 500 index fund. Then, every month, she takes that $1,352, the gap between her rent and the homeowner's total cost, and she adds it to the same fund. She doesn't touch it. She doesn't get fancy. She just lets it compound. Let's run the number. The S&P 500 has averaged roughly 10% per year over the last 30 years, and about 7% after inflation. I'm going to use 8% to be conservative, below the nominal historical average, above the inflation-adjusted one, a reasonable middle ground. $100,000 invested at 8% for 30 years. What does the lump sum alone become? $1,006,000. Just the initial investment doing nothing but sitting there compounding crosses $1 million. Now add the monthly contributions. $1,352 a month invested at 8% for 30 years. That becomes approximately $2,014,000. Add them together. The renter's portfolio after 30 years, roughly $3 million. And every cent of it is liquid. She can sell on a Monday and have cash on a Wednesday. Now look at the homeowner. After 30 years, her mortgage is paid off. She owns the house outright. How much is it worth? Historically, U.S. Home prices have appreciated at about 3 to 4% per year in nominal terms. Robert Shiller, the Nobel Prize-winning economist who literally created the Case-Shiller Home Price Index, showed that from 1890 to 1990, real home prices rose about 0.2% a year on average, basically flat after inflation over a full century. Recent decades have been somewhat better, but even being generous and using 3.5% nominal annual appreciation, that $500,000 house is worth about $1.4 to $1.5 million after 30 years. So the homeowner has a $1.5 million house. The renter has a $3 million portfolio. Let me be honest with you, those numbers aren't perfectly apples to apples yet. We need to look at what each person actually spent and what they actually got back. So let's go deeper. Over 30 years, the homeowner sent the bank $957,960 in mortgage payments. Of that, $400,000 went to principal. She got that back in the form of equity. The other $558,000, interest, dead. She spent $225,000 in property taxes, dead. $54,000 in insurance, dead. $149,000 in maintenance, dead. Total dead money for the homeowner over 30 years, $986,000. Let me say that number again because it matters. $986,000, almost $1 million spent on a house that she will never get back. Her net position, a $1.5 million asset free and clear from a starting home price of $500,000. That's $1 million in appreciation, minus $986,000 in dead money. Net wealth gain, roughly $14,000 over 30 years. Now, there are caveats. We'll get to the tax benefits and leverage arguments in a minute. But at the raw arithmetic level, the homeowner spent almost $1 million in dead money to gain about $1 million in home appreciation. Essentially, she broke even. The house stored her wealth. It didn't grow it. The renter? She spent $900,000 in rent over 30 years at a flat $2,500 a month. All dead. but she has $3 million in her brokerage account. Her net wealth creation portfolio, minus the difference in dead money, is in another league entirely. And this is where you should feel the central concept clicking. Dead money is the silent killer of the homeownership wealth equation, not the purchase price, not the down payment, the leaks. The relentless, compounding leaks that nobody puts on the glossy brochure. Now, let me be honest about the catches, because there are several, and they're real. Catch number 1. Rent doesn't stay flat. I use $2,500 a month for 30 years. In reality, rent increases over time, typically around 3% a year. By year 15, that rent might be closer to $4,000. By year 30, maybe $6,000. Meanwhile, the homeowner's mortgage payment is locked at $2,661. That's a genuine advantage of buying your biggest housing expense is frozen in time. As rent rises, the monthly savings gap narrows, and the renter has less to invest each month. This doesn't erase the renter's advantage, but it shrinks it, meaningfully. But here's the counter to the counter. The homeowner's costs aren't all fixed either. Property taxes go up as the home's assessed value climbs. Insurance premiums rise. Maintenance costs rise. A new roof on a $500,000 house costs X. A new roof on a $1.5 million house costs more. So both sides face rising costs. The homeowner just has one big fixed component, and the renter doesn't. Catch number 2. This math only works if the renter actually invests the difference every single month for 30 years. No skipping, no dipping into the account to buy a car. No panic selling when the market drops 40%, which it will do at least once or twice in any 30-year window. The discipline required is enormous, and most people simply don't have it. That forced savings mechanism of a mortgage, it's worth a lot precisely because most humans are bad at voluntary savings. If you know you won't invest the difference, this entire argument is academic. Buy the house. Seriously. Catch number 3, taxes. The homeowner historically could deduct mortgage interest from her taxable income. That benefit has gotten significantly smaller since the standard deduction rose to the mid-20s and most homeowners no longer itemize. But it's still real for some. And when she sells, she can exclude up to $250,000 of capital gains from taxes, $500,000 if married. The renter, meanwhile, will pay capital gains taxes on her investment returns when she eventually sells. Long-term capital gains rates, holding costs, potential state taxes, these reduce the renter's final number. Not enough to close a $1.5 million gap, but enough that honesty requires mentioning it. Catch number 4, leverage. This is the argument sophisticated real estate people make. The homeowner put down $100,000 and controls a $500,000 asset. If the house goes up 20%, her equity goes up $100,000, 100% return on her down payment. That leverage works in reverse too. Of course, if the house drops 20%, her equity is gone. But in a rising market, leverage amplifies returns. It's the reason some homeowners do genuinely build wealth through real estate. The math I've shown you here is for a single primary residence, not for a portfolio of rental properties. Real estate investors who buy multiple properties with leverage and collect rental income are playing a different game entirely. So I want to be clear about something. This video is not saying never buy a house. It's saying that the specific claim that renting is throwing money away and buying is the guaranteed path to wealth is mathematically wrong. Both renters and owners throw money away. The question is how much and what you do with the rest. Now let's look at what history actually says, because this isn't just theory. The S&P 500, the 500 largest public companies in America, has returned roughly 10% annually over the last 100 years, including dividends. Adjusted for inflation, about 7%. That includes the Great Depression, the dot-com crash, the 2008 financial crisis, COVID, and every other piece of bad news along the way. 10% nominal through all of it. U.S. housing. Shiller's own data showed that from 1890 to 1990, the real return on housing after inflation was essentially zero. 0.2% per year. Now, the last 30 years have been kinder. The post-2012 recovery and the pandemic housing boom pushed real returns higher. But even being generous and calling the long-run nominal return on housing 4%, compare that to the stock market's 10%. That's a 6 percentage point gap, compounding annually over decades. In the world of compound interest, that gap is a chasm. And remember, the housing return is the gross appreciation of the home itself. It doesn't account for any of the dead money, the interest, the taxes, the insurance, the maintenance. The S&P's 10% is a total return. You buy the index, you hold it, you get 10%. You buy a house, you get 4% on the asset, and you spend 6 figures on the upkeep. The net return on primary residence homeownership after all costs has historically been close to zero in real terms. The stock market's real return has been close to 7%. This is not a close race. But, and this is important, the future is not the past. Nobody, including me, can tell you what the stock market will do over the next 30 years. It could return 7%. It could return 4%. It could return 12%. There are no guarantees. A renter who goes all in on equities is exposed to volatility that a homeowner never faces. You can't be margin called on your house. You won't panic and sell your kitchen at the bottom of a recession. The emotional stability of homeownership has real, measurable value, even if it doesn't show up in a spreadsheet. So let me tell you who this video is actually for. This isn't for the person who's already bought a home, loves it, and plans to live there for 30 years. You made your choice, and there are genuine reasons it might be the right one for you. I'm not here to make you feel bad about it. This video is for the person standing in front of the decision right now, hearing the phrase, renting is throwing money away from well-meaning family members, and feeling pressured to buy before they're ready. I want you to have the real numbers. I want you to know that the comparison isn't between building equity and throwing money away. It's between two different ways of deploying your money, both of which have dead money, and one of which, if you have the discipline, generates significantly more wealth over time. It's for the person who can't afford a down payment right now and feels like they're falling behind. You're not. If you take the money you're saving toward that down payment and invest it now today, the math says you might end up ahead of the person who bought the house. Not because you're smarter, because compound interest is that powerful when it doesn't have $1 million worth of holes to leak through. And it's for anyone who's been told there's only one right answer, when the truth is there are two right answers, and the better one depends entirely on you. Here's the dead money test you can run on any property, at any price, in any city. Add up the total monthly cost of ownership, mortgage, taxes, insurance, maintenance. Compare it to the rent on a similar place. Take the difference. Ask yourself honestly, will I invest this difference every month for the life of the loan? If yes, run the compound interest calculation. You might surprise yourself. If no, and be honest, then buy the house and let the forced savings do the work. Either way, you'll have made the decision with your eyes open, with real numbers, not slogans. Because here's the thing about dead money. Everyone pays it. Renters pay it. Homeowners pay it. The only question that matters is how much of your money is dead and how much is alive and growing. And the single most important variable in that equation isn't your house. It isn't your rent. It isn't even the stock market. It's you. It's whether you run the numbers or just repeat what everyone else says. Run the numbers. If that's the way you want to think about money, run the math first. Decide second this channel is built for you. Subscribe, and I'll see you in the next one.